Markets are shut, but risk is not. While traditional exchanges sit in darkness, gold is repricing in real time. Silver is trading at levels the paper market hasn't even acknowledged yet, and somewhere between missile headlines and closed trading floors, capital is quietly moving. This isn't about a weekend spike. It's about what happens when financial plumbing freezes, while geopolitical pressure keeps rising. When oil routes are threatened, when inflation is already fragile, when central banks have no room left to maneuver, what opens next may not resemble what just closed. And the question serious decision makers must ask is simple: is this a temporary shock, or the beginning of a structural monetary reset? Welcome to Boring Currency FX. If you've seen a few market cycles in your lifetime, perhaps more than 50 years, then you already know the quiet moments before reopening bells ring are often the most dangerous. So go ahead and subscribe. Not for noise, but for clarity when it truly matters. And tell us, where are you watching from today? Gold reaching $5,494 and silver approaching $120 while major exchanges were closed signaled something deeper than simple volatility. It signaled stress inside the global financial system. At the moment of escalation, traditional commodity markets were inactive. COMEX was closed. London bullion desks were offline. Futures exchanges were dark for the weekend. Under normal conditions, these platforms provide organized price discovery. Buyers and sellers meet, contracts change hands, and risk is absorbed in structured ways. But this time, geopolitical tension intensified while markets were shut. That distinction matters. When exchanges close, risk does not disappear. It accumulates. Investors cannot adjust positions. Institutions cannot hedge exposure. Funds cannot rebalance portfolios. Pressure builds quietly behind closed trading systems. In this case, the only active price signal came from tokenized gold trading continuously on blockchain-based platforms. These markets operate around the clock. They do not close for weekends or geopolitical shocks. And their gold printed $590, roughly $250 above the previous official close. A $250 move in a compressed time window without full institutional liquidity is not routine fluctuation. It represents repricing. It suggests that capital was moving toward perceived safety wherever access remained available. For business leaders and entrepreneurs, this detail is critical. When capital cannot move through standard financial channels, it seeks alternative routes. Tokenized markets became the pressure valve for global finance. Simultaneously, a second signal emerged in Asia. In Shenzhen's physical precious metals district, silver buyback prices reportedly approached $120 per ounce, far above the last international paper price in the low 90s. This created a sharp divergence between paper pricing and physical reality. Such gaps are rare. Futures prices are largely driven by leveraged contracts and often settled in cash. Physical markets reflect immediate supply and demand for actual metal. When the difference widens dramatically, it suggests the two systems are responding to different expectations. In practical terms, the number on financial screens and the number in real-world transactions were no longer aligned. Dealers were reportedly paying strong premiums to secure silver inventory. Even more notable, some were reluctant to sell despite elevated prices. For businesses that rely on turnover, hesitation indicates caution. It suggests they believe holding tangible assets may be safer than holding cash. Precious metals function as monetary insurance. They do not rely on policy promises or central bank balance sheets. During uncertainty, they often reflect shifts in trust. The geopolitical dimension intensified the signal. The region involved in escalation sits near critical global oil infrastructure. Roughly 1/5 of global oil supply moves through a narrow corridor in that area. Any disruption introduces immediate inflation risk. Entrepreneurs understand supply chains. They understand fuel expenses. They understand transportation margins. Oil is not abstract. It affects production costs, logistics, and consumer pricing. When gold rises sharply under such conditions, it reflects more than headlines. It reflects expectations of economic consequences. Exchange closures created compressed risk. Institutional traders were unable to respond instantly. Banks could not rebalance exposure in real time. This delay can produce powerful movements when markets reopen. Historically, geopolitical shocks during closed sessions often result in significant reopening gaps. Prices adjust all at once to account for accumulated fear or accumulated demand. For serious decision makers, the key issue is not short-term fluctuation. The key issue is what the repricing implies about monetary confidence and systemic stability. If conflict remains contained, metals may stabilize at higher levels. If escalation threatens energy flows and inflation accelerates, repricing may continue. The $5,494 gold print and $120 silver signal were not random numbers. They were early indicators from the parts of the market that remained open. When traditional systems pause and alternative systems adjust aggressively, it suggests capital is moving ahead of official reassurances. Business leaders do not react emotionally to such signals. They review liquidity. They examine exposure. They reassess risk concentration. Because when markets close but risk does not, preparation becomes the dividing line between stability and vulnerability. Gold did not rise in isolation. Silver did not surge without reason. Behind the headlines, behind the military escalation, stood a far more powerful force: oil. Every modern economy runs on energy. It powers factories, it fuels trucks, it keeps supply chains moving. Without stable energy prices, no business model remains stable for long. The conflict placed immediate attention on one narrow stretch of water, the Strait of Hormuz. Nearly 1/5 of global oil supply passes through this corridor each day. It is not wide, it is not easily replaced, and it cannot be ignored. For entrepreneurs, the issue is not geography, it is dependency. If even the threat of disruption emerges, shipping insurance premiums rise, tanker rates increase, oil futures spike, energy companies adjust pricing expectations, and once crude oil climbs sharply, the effect spreads quickly. First, fuel costs increase. Transport companies face higher diesel prices, airlines adjust ticket prices, shipping firms raise freight rates, delivery margins shrink. Then manufacturers feel the pressure. Factories that rely on energy-intensive processes see input costs rise. Packaging, plastics, chemicals, fertilizers, all depend on oil derivatives. Then retailers feel it. When transportation and production costs increase, final goods become more expensive. Grocery bills rise. Consumer purchasing power weakens. This chain reaction is known as cost-push inflation. Unlike demand-driven inflation, which central banks can attempt to cool by raising interest rates, supply-driven inflation is far more difficult to control. Raising rates does not create more oil. It does not reopen a blocked shipping route. It does not lower tanker insurance costs. This is where the Federal Reserve faces constraint. If inflation accelerates due to oil shock, the central bank must consider tightening monetary policy. But if the economy is already fragile, burdened by high debt levels and slowing growth, higher rates risk pushing businesses into contraction. If the Fed cuts rates to support growth during geopolitical stress, it risks weakening the currency and worsening inflation. Either decision carries cost. Business leaders should understand this dilemma clearly. Central banks operate within limits. They do not possess unlimited tools. When supply shocks meet high debt and fragile growth, policy flexibility narrows. This makes markets sensitive. In 1973, during the oil embargo, crude prices surged dramatically. Inflation rose into double digits. Equity markets declined. Gold prices multiplied over the following years. The period demonstrated a simple reality. Energy disruption reshapes financial landscapes. Today, the global economy is more interconnected than it was decades ago. Supply chains stretch across continents. Just-in-time inventory systems reduce buffers. Many businesses operate on thin margins. This structure increases vulnerability. If oil moves from stable levels toward extreme levels, for example, $150 or $200 per barrel, the inflationary wave would not remain contained. It would flow into construction costs, agricultural inputs, transportation networks, and consumer goods. Entrepreneurs planning expansion must account for such volatility. A business model that works under predictable energy pricing may struggle under shock conditions. There's another dimension. Governments with large fiscal deficits depend on manageable borrowing costs. If inflation rises sharply while economic growth slows, bond markets demand higher yields. Higher yields increase government interest expenses. This creates fiscal strain. When fiscal strain meets geopolitical instability, investors begin to question currency stability. And when currency confidence weakens, capital often rotates toward hard assets. This is one reason gold responds strongly during oil crises. It is not simply reacting to fear, it is reacting to monetary pressure. Rising energy costs weaken trade balances for oil importing nations. Currency depreciation risk increases. Central banks in vulnerable economies may increase gold reserves to strengthen balance sheets. For business owners, this environment requires disciplined thinking. They must evaluate supplier exposure. Are key inputs tied to energy-intensive processes? They must assess pricing flexibility. Can they pass higher costs to customers without losing market share? They must review liquidity buffers. Can they withstand several quarters of margin compression? Oil shock is not just a macroeconomic concept. It becomes a balance sheet event. The recent escalation introduced the possibility, not certainty, of disruption. Markets do not wait for certainty. They price probability. If traders believe that even a small chance exists of shipping disruption or extended conflict, oil futures incorporate that risk premium immediately. Metals then reflect expectations of sustained inflation and monetary strain. In this way, gold and silver movements act as early warning indicators. They signal that the system may be entering a higher risk regime. Serious decision makers do not panic at such signals. They analyze them. They prepare contingency plans. They reduce unnecessary leverage. They preserve optionality, because when oil becomes unstable, inflation follows. And when inflation accelerates in a world already burdened by debt and fragile growth, financial stability becomes more delicate than most realize. In calm times, most investors trust the number on the screen. They see the spot price of gold. They see the quoted price of silver. They assume that number represents reality. But during periods of stress, the structure behind that number begins to matter more than the number itself. The global precious metals price is largely determined in futures markets. Contracts are bought and sold in large volumes. Many of these contracts never result in physical delivery. They are settled in cash. Traders speculate on direction. Institutions hedge exposure. Algorithms provide liquidity. Under normal conditions, the system works efficiently. However, it relies on confidence. Confidence that contracts can be rolled forward. Confidence that counterparties remain solvent. Confidence that delivery mechanisms function smoothly. When geopolitical escalation coincides with exchange closures, that confidence is temporarily suspended. Price discovery slows. Liquidity narrows. Risk builds beneath the surface. This is where divergence can begin. In Shenzhen's physical silver district, reported buyback prices approached $120 per ounce, while the international futures price remained significantly lower. That gap is not just a premium, it is a signal. The paper market price reflects leveraged positioning and speculative flows. The physical price reflects immediate demand for tangible inventory. When those two numbers separate meaningfully, it suggests stress in the system of price transmission. For entrepreneurs and business owners, this is similar to supply chain distortion. Imagine a commodity that trades at one price in a derivatives contract, but at a higher price when purchased physically for immediate use. That difference reveals scarcity, urgency, or distrust in future delivery. Silver is particularly sensitive to this dynamic. Its total global market size is far smaller than gold. It serves both as a monetary metal and an industrial input. Solar panels, electronics, and advanced manufacturing processes require it. This dual role makes its demand base diverse and sometimes inelastic. If physical holders hesitate to sell at elevated prices, liquidity tightens further. That behavior reflects expectation. When dealers believe tomorrow's price may be higher than today's, they delay selling. For businesses whose income depends on inventory turnover, such hesitation signals structural concern, not speculation. Meanwhile, leveraged short positions in futures markets introduce additional risk. When markets reopen after a shock and prices gap upward, traders who bet against metals may face margin calls. A margin call forces the trader to either deposit more capital or close the position. Closing a short position requires buying back the contract. This creates forced demand. If multiple short sellers face pressure simultaneously, a cascade can occur. Each buy order pushes price higher. Higher prices trigger more margin calls. More margin calls trigger more buying. This is known as a short squeeze. In large, deep markets, squeezes may be absorbed gradually. In smaller markets like silver, where liquidity is thinner, price moves can accelerate quickly. The key insight for serious decision makers is this: price is not only determined by fundamentals, it is also shaped by positioning. If physical demand rises while leveraged short positions remain elevated, the imbalance can create asymmetric outcomes. Upside volatility increases. Business leaders should view this through a strategic lens. Markets are ecosystems of incentives and obligations. Futures traders manage leverage. Physical dealers manage inventory. Central banks manage reserves. Each participant reacts differently under stress. When geopolitical uncertainty intensifies and exchanges close temporarily, the ecosystem loses coordination. Physical buyers act based on immediate need or precaution. Speculators act based on expected momentum. Institutions act based on portfolio risk models. If these actors respond in different time frames, divergence expands. Another factor deserves attention. Many futures contracts allow for cash settlement. This means that even if delivery stress appears, contracts can theoretically be resolved without metal changing hands. While efficient during normal conditions, this structure may create skepticism during crisis periods. Market participants may question whether quoted prices truly represent the availability of physical supply. That skepticism alone can push more buyers toward tangible metal. In business terms, this resembles counterparty risk. If one doubts whether a contract will deliver as promised, one prefers holding the asset directly. For entrepreneurs managing currency exposure or commodity inputs, such moments highlight the importance of understanding market structure, not just price trends. If the paper market lags behind physical reality, repricing can be abrupt. Once exchanges reopen and global participants act simultaneously, alignment may occur through rapid price movement rather than gradual adjustment. This is why the divergence between $120 physical silver and a much lower paper price matters. It suggests that the adjustment process is incomplete. In periods of calm, price differences narrow quietly. In periods of stress, they close through volatility. And when positioning, leverage, and physical demand collide during geopolitical uncertainty, markets rarely move slowly. At this stage, the question is no longer whether volatility exists. The question is which path the system follows next. Serious business leaders do not operate on headlines. They operate on scenarios. They examine probabilities. They prepare for multiple outcomes. The current situation presents three primary paths, each carrying different implications for capital, liquidity, and strategic planning. Scenario 1. Contained conflict. In the first scenario, escalation remains limited. Military strikes occur, but retaliation is controlled. Oil infrastructure remains operational. Shipping lanes stay open. Diplomatic backchannels reduce further expansion. Under this outcome, gold stabilizes at elevated levels. It may remain above previous resistance, reflecting increased geopolitical risk. Silver holds firm, but begins to narrow its extreme physical premium as fear subsides. For entrepreneurs, this environment still demands caution, but not panic. Input costs may rise modestly. Inflation expectations may stay elevated, but manageable. Credit markets remain functional. Expansion plans can proceed with adjusted risk buffers. The key takeaway in this scenario is resilience. Businesses with strong cash flow and flexible supply chains will absorb the shock. Markets would treat the event as a temporary stress rather than a structural shift. However, even in containment, one change remains permanent: risk perception. Once markets witness how quickly escalation can unfold, risk premiums rarely return fully to previous lows. Scenario 2, escalation cycle. In the second scenario, retaliation intensifies. Strikes and counterstrikes continue. Oil markets price and persistent disruption risk. Insurance costs for tankers increase. Even without a full blockade, uncertainty pushes energy prices higher. In this environment, inflation regains momentum, not because of excess consumer demand, but because supply becomes fragile. Gold likely sustains strength above recent highs. Silver benefits from both monetary demand and industrial hedging. Capital rotates defensively. Institutions reduce exposure to risk assets and increase allocations to perceived safe stores of value. For business leaders, this scenario requires defensive adjustment. They would reassess leverage levels. They would secure fixed-rate financing if available. They would build inventory buffers where possible. They would examine foreign exchange exposure carefully. Energy-sensitive industries would experience margin pressure. Consumer-facing sectors might see weaker discretionary spending as fuel and food costs rise. Central banks in this scenario face constraint. If inflation accelerates due to oil shock, rate cuts become difficult. If growth slows, rate hikes become painful. Policy becomes reactive rather than proactive. For entrepreneurs, uncertainty itself becomes the cost. Scenario 3, regional war and financial shock. The third scenario represents systemic escalation. Multiple regional actors become involved. The Strait of Hormuz faces direct disruption. Oil prices spike sharply and remain elevated. Such an event would not simply influence markets, it would reshape them. Oil above extreme levels would transmit rapidly into global inflation. Bond markets could react negatively as governments face higher borrowing costs. Currency volatility would increase, especially for oil importing nations. Central banks might accelerate gold accumulation to stabilize reserve credibility. Investors could rush toward hard assets, creating sustained upward pressure on precious metals. Silver, due to its smaller market size, could experience amplified volatility. In extreme conditions, price adjustments may occur quickly rather than gradually. For entrepreneurs and business executives, this environment demands preservation before expansion. Liquidity becomes priority one. Debt exposure must be carefully managed. Capital expenditure plans may require delay. Supplier diversification becomes critical. This scenario is not a prediction, it is a risk assessment. Extreme events are rare, but their consequences are disproportionate. Across all three paths, one principle remains consistent. Preparation reduces vulnerability. The recent repricing in gold and silver may represent more than speculation. It may reflect a reassessment of global stability. When markets close but alternative systems reprice sharply, it signals that capital is repositioning ahead of formal responses. For serious decision makers, the lesson is not emotional. It is structural. They must examine exposure to energy volatility, sensitivity to inflation shocks, currency risk within international operations, liquidity, buffers under stress conditions. Opportunity always exists in volatility, but opportunity favors those who remain solvent and flexible. History shows that during geopolitical shocks, some businesses collapse under leverage and cost pressure. Others strengthen by managing risk early and decisively. The difference lies in preparation. Gold at $5,194 and silver near $120 may be early indicators of heightened systemic strain. Whether this moment becomes a brief spike or the beginning of a longer repricing cycle depends on geopolitical outcomes that remain uncertain. But uncertainty itself is the signal, and in times when uncertainty rises faster than policy can respond, disciplined strategy becomes more valuable than prediction.